Week 2 of e-learning. So today we are going to be diving into banking and other financial institutions. So this is topic 6 in your textbook for those of you wondering. So we'll be going over topic 6.4 to 6.7. Today I want you guys to be taking notes in your notebooks on this PowerPoint that I'm just going to walk you guys through. So functions of modern banks is where we will begin. All right, so a couple key terms that you're going to need to know. The first is liquidity. So liquidity is how quickly you can get your hands on cash money. If you've ever heard the term like liquidate your assets, that's people selling off their assets to get cash. So if you have something with high liquidity, you can easily get your hands on cash. You can easily turn that into money. Something with less liquidity is going to be harder to turn into cash. So if we think about our debit cards, you can easily go, you can use your debit card and you can purchase a cookie at the Minute Man Cafe and you can easily switch that debit card money into cash. If you think about something that has less liquidity, let's say you are a collector of really famous paintings. You may be able to sell that painting for cash, but it's going to take you a while to find the right buyer and get the amount of money that you rightfully deserve for that painting. That's going to take longer. So an item like that would have less liquidity. So that's what liquidity is. Interest, we've all heard of interest or interest rates. An easy way to think about interest is as the price paid for the use of borrowed money. So interest is the price that you're paying for the use of borrowed money. And we'll get into interest rates in a little bit. Principal is the original amount of money borrowed. So if you were to borrow money from the bank, your principal, let's say you borrowed $1,000, your principal is $1,000. Defaulting, when you default on something, that's a failure to pay back a loan. Okay, so that's what the term default means, failure to pay back a loan. So those are just a couple key terms that I want you guys to know moving forward with this section. Okay, so money supply. When we're talking about the US money supply, we're talking about all of the money that's available in the United States. That's what the US money supply is. We break that down into two different categories. There's M1 and M2. M1 is the money that people can easily use to pay for goods and services. So that would be our paper money, so our cash, our coins, deposits into checking accounts. The money in M1, that's going to be assets with liquidity, assets that can easily be turned into cash. Then we've got M2. M2 is all of the assets that are in M1 plus several other assets. Those are going to be the assets that have less liquidity. So deposits into savings accounts, for example, that would fall under M2. So when we refer to the US money supply, we're just referring to all of the money that's available in the United States, and that consists of a combination of M1 and M2. Okay, now this is what we're really going to get into today, and that's the functions of banks. So the functions of modern banks, they have 5 major functions. There's storing money, saving money, providing loans, providing mortgages, and issuing credit cards. Those are our 5 major functions of modern day banks today. So there is a slide for each of them. So the first is the storing function. So banks, we know they store money. The storing function is our most basic function of banking. They provide a safe, convenient place to house your cash so that you don't have to keep your cash under your mattress, for instance. You can keep it in the bank. Banks keep cash in fireproof vaults. Oh, goodness. Okay. Sorry, guys. Banks keep, my mom called. See, teachers, they're just like you. Okay. Banks keep cash in a fireproof vault, and they are insured against the loss of money in the event of a robbery. They are also FDIC insured. Oh my gosh. How do I turn this off? Okay. The FDIC insurance will protect individuals from losing their money if banks are unable to repay funds. FDIC, that's the Federal Deposit Insurance Corporation. So that's just insurance and it's protecting your money that you deposit into a bank. So what the FDIC does is that they will insure $250,000 per depositor per bank that's insured. Okay, so that's to make sure that if the bank goes under, if the bank gets robbed, if there's a disaster of some sort, then your money is insured. You're not going to lose your money. Up to $250,000, you're not going to lose that because it's insured by the FDIC. Okay, so that's just a brief overview of the storing function of banks. Another function of banks is the saving functions. Banks, we know, allow us to save money. There are multiple types of accounts, but for the sake of time and clarity, I just want to go over savings and checking accounts. These two are our most common types of bank accounts and are probably the ones you guys have heard most about. Banks pay interest at an annual rate. So if we look at this example, let's say you got $1,000 and you said, okay, I'm going to put this into a savings account because I'm going to need that money for college. So you put $1,000 into your savings account, and let's say your savings account has 1% interest. What that would mean is, let's say you put that $1,000 in and you don't touch it for a year. Okay, so you're not going to put any more into it. You're not going to take anything out of it. Let's say you just put that $1,000 in there. You're going to leave it. And then on March 22nd, 2021, you look into that account and you'll have $1,010 in there. Okay, so if we take a look at that 1% interest, we know that interest is the price paid for the use of borrowed money. So by putting your money into the bank, you are technically allowing that bank to borrow your money. Okay, so you're allowing the bank to borrow from that $1,000, and then they are paying you 1% interest. So by putting your money in that bank, then by the end of a year, you'll receive a whopping $10. So by saving money using a savings account, it's very low risk. Because you know that your $1,000 is going to be there a year later. You're not risking anything really by putting $1,000 into your savings account, but it's also low reward. The only thing you got out of that was $10, right? So you're not risking much by putting it in there, but you're also not gaining much by putting it in there. If we think of something that's more high risk and high reward, that could be investing in a certain company in the stock market, right? You might decide I'm going to put $1,000 worth of share in Apple. If Apple crashes, then you lose your $1,000, right? But if they thrive, then you have the ability to make a lot more than $1,000 when you sell your shares in stock. Okay, so savings and checkings account, low risk but low reward. Our next bank function is the loaning function. Banks allow individuals like you and I, as well as businesses, to borrow money. So a benefit for borrowing money from the bank would be being able to purchase an item that you might not otherwise be able to afford because you'll be able to pay off your loan at a later date. So let's say you needed to take out a loan for your college education. You might not be able to afford to go to college unless you were able to take out that loan. So that's a benefit for you as an individual. A cost of that, though, is the potential for higher interest rates. So let's say you were to take out a loan, the bank is going to charge you an interest rate for every year that you have that loan or every month you have that loan. So then when you're paying off your college education, you're not just paying off the cost of college, you're paying off the interest as well. So you're paying to borrow that money. Another cost of loaning or borrowing money, is that you could default. So if you have an inability to pay your loan, then that's going to result in a poor credit score. If you have a poor credit score, you're not going to be able to get, or you're going to have extreme difficulty getting loans in the future. You're going to struggle with renting an apartment or with leasing a car. Okay, so those are some benefits and some costs of borrowing money. If we take a look at the loaning function from a bank's perspective, the way that banks are making money is through interest. So the ability to earn money through their higher interest rates, that's going to be a benefit for the banks. The more money that a bank lends, the higher the interest rates they're going to charge, because it's risky for a bank to lend out a bunch of money. So if they're going to lend a lot of money, they're going to want a lot of reward. Okay, so the more money a bank lends, generally the higher interest rates they're going to charge. The cost for the banks, if we go back to just the very basics of economics, they're facing a trade-off, right? So they're choosing a trade-off between profit, so making a lot of money, right, by loaning money and then increasing their interest rates. But their opportunity cost might be safety. Okay, so if borrowers are going to default or they're not going to repay, then the bank might lose some of their money or all of their money and go under. Okay, so they have to face a trade-off decision between profit and safety when they are looking at their loaning function. This next function is they serve as providing mortgages. A mortgage is a specific loan that's used to purchase real estate. So some pros of home ownership: if you were to take out a mortgage and borrow money from the bank in order to purchase a house, the first is price stability. So you know how much you're paying for your mortgage, okay? You're not paying a different amount every month, every year. You're paying the same exact amount. If you were to rent an apartment, let's say you signed a year-long lease, your landlord might up your rent after that year is up and you go to a month-to-month basis. They might charge you more than you had originally signed for that first year of your lease. So a pro of owning a home is price stability. You know exactly what you're paying for a fixed amount of time. Another pro of owning a home is that it's an investment. So when you purchase a home, your home value is going to increase with time, right? So if you're to purchase a home tomorrow, let's say you're a California resident, you're purchasing a $1 million home tomorrow, it's going to be worth more than $1 million in 5 years. Okay, so your home value is going to increase with time. Some cons of owning a home: you have to put a very large amount of money down as your down payment. Okay, so you might take almost all of your savings and put it into the down payment for your home. Okay, it's a lot of money. You also have less mobility as a homeowner. So let's say you purchased your home, you thought you were going to be settled down in Pasadena, California for a while, and then all of a sudden your spouse gets a job opportunity in Texas. Well, shoot, you have this home. What are you going to do? Okay, so you don't just have the ability to up and move to another state, another city very easily. Whereas if you're renting or if you're leasing, you have the ability to move more easily. This function here is the credit cards function. I think that's the last function that we're going to cover in this PowerPoint right now. So what credit cards are, they are cards that entitle their owners to buy goods and services based on the owner's promise to pay. So go ahead and get that down in your notes. Credit cards are cards entitling their owners to buy goods and services based on the owner's promises to pay. So how a credit card works at a very basic level. Let's say you go to the bank and you apply for a credit card. The bank issues you that credit card and they're going to say you have $5,000 to spend per billing cycle. Okay, so let's say you're going to have $5,000 that you can spend. The amount's going to vary, by the way. It's not 5,000. I'm just throwing that number out there. So let's say you have $5,000 to spend per month. And then at a later date, you'll be paying off that $5,000. So a pro of a credit card would be you have the ability to purchase goods that you might not otherwise be able to afford at the time. Let's say that you moved into your new house and you wanted to buy a couch. So you might spend $3,000 on a couch, but you don't have $3,000 in your account at that moment. You can still purchase the couch that you need for your home. And maybe when your next paycheck comes in, you're going to use the money from that paycheck to pay off your credit card. Okay, so a pro would be you have the ability to purchase goods you couldn't afford otherwise at that time. Another pro is that it helps you to build credit. Everybody needs credit, okay? You need credit for home loans, for cars, for apartments, for a lot of major purchases. So by utilizing your credit card and paying off your credit card, you're building a good credit score. A con or a downside to credit cards would be people who are unable to pay their credit card in full. Then they're going to continue to accrue high debts, okay, that eventually are going to become really, really difficult to repay. So if you can't pay it in full, then your interest rates are going to keep increasing and you're going to get yourself into a mountain of debt. So if there is anything that you take away from this entire economics course, I hope it's more than this, but if there is one thing, I want it to be that you always pay your credit card in full. Do not get into credit card debt. That's going to destroy you. Always pay your credit card in full. Be cautious. Pay close attention to whatever you're getting yourselves into when you look at credit cards and signing up for a credit card, but always, 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 always pay your credit card in full so that you don't go into debt. Okay, cool. Let me see. Yes, that is where I wanted to end. Okay, so for your attendance today, you will be uploading a photo of your notes on this little section. Okay, take a look at MyMHS under the e-learning topic so that you know what you're doing with the rest of the week. All right, have a good one, guys. Bye.